So here we go, the UK stocks I'm buying October 2024 edition. This is where I go through all the UK stocks that I bought and sold between the 1st of September to the 1st of October. I've done this series for many years on the YouTube channel, and the reason why I do it is just for transparency reasons, so you get to see what I'm buying, what I'm selling. I don't try to hide anything that I'm selling out in the background that hasn't worked out. If it hasn't worked out, I'll show you on here, and I'll also show you the stocks that have worked out on here, and as well as that, I'll show you everything I'm buying, so I don't pop up in a year or two's time going, hey, look at this stock, I'm up so much on this position. You'll see it right now that I'm buying that position. So hope you enjoyed the video. If you could hit the like button, as well as that, if you're new around here, subscribe. We're very close to 16,000 subscribers. I think we're around about 28 subscribers off it. So if you get me there, I'll do a live Q&A session for you guys on the main YouTube channel on Sunday for you guys. But apart from that, let's get started. Now, just a quick shout out, if you are a Patreon member, go check out the exclusive video on the Patreon, which is my UK portfolio, and you get to see how it is currently doing at the moment, how much I'm up and down on every position, and the allocation of every position in my portfolio. If you do want to see the exclusive content, 2 exclusive videos a week on Patreon, join through the link in the description. £5 a month, and you also get a Discord with 500 members on to talk about stocks, including me. Not bad at all for £5 a month. Price of a pint is the highest Patreon to YouTube subscribers out there on the whole stock market scene, and I'll let you guys know that the Patreon will be going up to £10 slowly through 2025, so it's not going to be at £5 for much longer. So this is your time to take advantage of it if you want to get it at the lower amount of cost. As well as that, if you want to start investing, join Trading 212, the link in the description. You get a free share worth up to £100. That's personally the investing platform app I use to go buy my stocks and shares. But getting on to the stocks, number one is Gaming Realms. So I did buy some shares in Gaming Realms in the last couple of weeks. The stock had a little bit of a dip, as you can see here, when it brought its trading update out. Since then, it has recovered it slightly, so I am back up on that position. But at the time, I went to only up like 1 or 2% on the position. I'm now back up about 14% on the position, but I did take advantage of the dip in Gaming Realms earlier this month. They are a provider of iGaming games, mostly the Slingo games, as you can see here, and they provide them to the likes of FanDuel, William Hill, DraftKings. And if we actually go on to Foxy Bingo here, you'll be able to see some of the Slingo games that have like Deal or No Deal Slingo here, which in my opinion is going to be a big growth driver, because you don't just have the UK markets, the Europe markets, you have the big expansion into likes of Latin America, the US, which we've covered before with the likes of DraftKings, which is going to be a big growth in iGaming in the next few years. Now, the stock dropped off earnings, which I am really surprised by, because I thought the earnings were absolutely amazing. Revenue, as you can see here, grew by 18%. Adjusted EBITDA was up 21%, and profit before tax was up 51%. There was also a lot of highlights in the recent update with new partners, expansion into new areas, and with different companies, as you can see here, new games that were also launched. Everything just got better and better, in my opinion, with the business. And you look at the past performance of the company now, you can see the past performance and the future performance. Very nice growth in revenue, very nice growth in profitability. You're picking up a company with a very good balance sheet, as you can see here. No debt on there. Nice current cash pile of around about 9.5 million, which I think they'll ultimately start doing some share buybacks with. And if we go on to Stockopedia, you can see here that the growth is expected to continue growing at very nice rates. On a P ratio basis, it's currently trading at 14 times 2024 numbers and 11 times earnings on 2025 numbers. I think for a company like this on the UK markets to be at 14 times earnings is a little bit ridiculous. I think this is a premium company and should be at least 20 times earnings. I think you can argue the case that it should be 25 to 30 times earnings. So I think it's already undervalued by a fair amount, and then you start factoring the growth in. Yeah, this to me looks like a very attractive opportunity, especially when you look at the potential for that US growth in the next few years, especially in the US with iGaming. Number 2, Money Group. Not a big surprise to see this on the list. This is currently on the path to be my number 1 position in the UK portfolio. I also did a video the other day calling it my number 1 stock for 2025. Yeah, it's had a bit of a tough time at the moment. The stock is down 21% year to date. I don't know why it's down that much, because the company has actually done really good financials, and there's big tailwinds coming up next year for the company. 15 times earnings, which I think is absolutely crazy. This should be 20 times earnings for a company like this. even without any share price return, you're going to be picking a 5.6% dividend yield, and that dividend will grow over the next few years. So within a couple of years, you'll be able to say that it's around about a 6% dividend yield from where it is right now. Money Supermarket is a price comparison site, so they do all these price comparisons like car insurance, home insurance, broadband deals. And the great thing about being so diverse is when something does pretty poorly, the other parts of the business seem to recover a lot of the weakness. So for example, travel has been really strong at the moment because everybody has been going on holidays because of the COVID lockdowns. And for example, something like mortgage deals is a little bit weaker at the moment because interest rates have been so high, and that's another big thing that's going to be a big tailwind for them in the next few years, in my opinion, is if interest rates start coming down. Obviously there's a lot of these part of the platforms that should really do well from lower interest rates. The other thing as well is the recent updates were still very good. Revenue growth of 5%. If you look at profit after tax, was up 8%. And in my video that I did around about 2 weeks ago, which you can see here, which is my #1 UK stock for 2025, I talked about potentially the new Super Save Club they've launched. This is a way of attracting more members onto the platform, linking up them that they have all of their expiring insurances, phone deals, broadband deals, so it's all linked on one platform. They get notifications when they need to renew the insurance, and because it's all on one platform, they also get loyalty reward points from keep linking up and shopping by using the platform, which is something they've only recently launched and should be a great driver for them. But the big thing that, if you go on this video, that I said is the big tailwind for this company is the energy switching part of the business. The energy part of the business has been stopped since the energy crisis, and it is expected to come back in 2025. The ability to compare and get cheaper energy deals was a big part for Money Supermarket only a few years ago since it was stopped. Now, like we said, it is expected to come back in 2025. And to show you what they're kind of missing out on here, if we go back to 2020's numbers, which was 38 million, and by the way, this is half year results. So if you go back to 2020 numbers, they were making 38 million from their home service revenue. If we actually go to what they currently did in their latest quarter, they currently did 16 million. So it's about a 22 million gap on the home services from that energy market that's missing. If that comes back in 2022 and we do lazy maths and double it, because obviously it's half a year, that's around about 44 million they're currently missing out on potential energy switching market. That's 44 million that will be thrown on the top line and more than likely on the bottom line, because basically the platform is there sitting waiting for it to come active again. And what we should see there is the explosion in profitability and the revenue, and I think that's what some analysts are starting to forecast in here, as you can see here. And obviously they do really good chunks of profitability. That's why if you look at the past performance, for example, the company actually used to have higher profit margins. It was around 23% profit margins, and it's down at 17% profit margins. It's because that energy part of the business is not being used. When that energy part of the business will be used, a lot of that profitability will go straight to the bottom line. The profit margins will increase and the revenue will increase. And I think we'll be talking about nearly a company doing 100 million profitability. 100 million profitability on 1.2 billion market cap, in my opinion, is very attractive. As well as that, you're picking a company up with a decent balance sheet, as you can see here, 21% debt to equity, and also insiders have been buying the shares, which is obviously another really positive sign. And obviously, without even the share price doing anything, you're going to be collecting a really nice dividend. And like I said, when you look at the company right now, it's currently sitting at 11 times forward earnings. This company historically trades around 20 times earnings. So yeah, it's a very discounted value for a company of this quality. I really like this one. The next one, Warpaint. I did buy some more Warpaint. Same again, a bit like a Game Realms. I bought it on its dip. It had a bit of a dip after it reported earnings, and I thought the earnings were absolutely amazing. I bought the dip, and since then it has gone up a little bit, so just bear that in mind that I was buying it a little bit, about 10% cheaper than where it is currently today. Now 26 times earnings, that's not really a true reflection, because when you do look at a forward PE basis, because of growing profitability that much, it's actually a lot cheaper, but they do pay a little bit of a dividend here. Warpaint has been a very good performer on the UK market, and I think it has the potential to carry on performing very well going forward. Now it is a seller of makeup. A lot of it does come through the W7 brand. They also got a couple of other brands like Technic, for example, but majority of the revenue does come from this brand called Warpaint or W7. If you go on the recent financials, I thought they were really good. Revenue of 25% growth. That's obviously very much above average growth. That's what you'd pay a premium for. Gross margin expansion, they've got a really good gross margin expansion going on here, which is obviously fantastic. And what I said before is about, it's not a true reflection of profitability because it's ramping up so fast. You look at the EPS, it grew 67% year over year. You look at some of the highlights here, very good highlights. International revenue grew more than the UK revenue, which is great. This has historically been a UK company. They're now expanding internationally, and that growth is very good, as you can see here. W7 growth of 25%, Technic sales were up 34%, gross margin expansion because they're growing up, the scale is growing up a lot more, and the Europe growth was actually very good during this quarter. And because the company's growing so fast, actually on a forward times earnings, this is 14 times earnings for a company that are doing these sort of numbers. And if you look at the future growth because of this international expansion, if they can do what they've done in the UK into Europe and into the US, the growth plan looks very good for the next few years, and you can see that growth of revenue and profitability going on here. And by the way, this platform is Simply Wall Street. If you do want to join Simply Wall Street, there's a link in the description. You join through that link, you get a 14-day free trial, and on the 14th day you should get a discount code for 40% off for a year subscription. I think it's a great platform. It's one that I personally use. Balance sheet wise, it's also got a cracking balance sheet, as you can see here. No debt on the balance sheet. They've got a nice little cash pile going on as well, and obviously there's potential for that dividend to carry on getting expanded up as well. So yeah, big fan of Warpaint. Next one, Supreme. This was a stock that I actually bought this week, so this is quite a relatively newer buy. It's having a bit of a dip at the moment from its all-time highs, or its 52-week highs. It's down about 21%, so having a little bit of a correction going on at the moment. Though year to date it's still up 45%, which is still pretty good, and I'm up still around about 40% on my position. I have started averaging back up on my position now. I'm sure if you watched last month's video, you would have seen that I did take a bit of profit off the table. I just thought it just ran up a bit too much. Looked like I've done that absolutely perfect for once, which is great. Now it's down. I'm using that cash that I took off the profit a little bit, putting it back in. I also received the dividend as well, and I used a bit of the dividend money back into the stock. 8 times earnings, which I think is good value. You get a nice little 3% dividend yield as well when you're holding Supreme. They are a distributor, a wholesaler of a lot of products, so they have quite a few divisions of batteries, lighting, vaping, health and wellness, and soft drinks. Soft drinks is a new acquisition they've made, which is quite exciting to see how that expands. Vaping is obviously a big growth sector, obviously a little bit of regulation around that, that's why it does trade at a lower valuation, but that should be a big growing area for them in the next kind of few years. If you look at the recent numbers that Supreme did on the full years, they were very impressive. Revenue up 42%, they had their gross profit up 12%, adjusted profit before tax was up 102%, EPS was up 85%, the net debt came down by 74%, and adjusted net cash went up 263%, and a lot of that goes to their expansion of delivering and being the supplier of Elf Bar and Lost Mary, which is a very big vaping brand, and that is helping them do very well going forward. Looking at the future of the business, the growth is expected to continue according to Stockopedia, which once again you can join through the link in the description and get 25% off. And on a P ratio basis, it's going to go down to, well, I mean, it's already at an 8, and then it's going to go down to an 8.2 and a 7.9, which, even though this is going to be a lower P ratio because of the potential exposure to vaping, I still think this is a little bit low for Supreme. I think it should maybe be around about 12-13 times earnings, and as well as that, you also have the company still growing at very good rates, so that valuation is only going to continue to drop. So Supreme, I like Supreme. You're also going to once again collect a nice little dividend holding the stock. The CEO did also buy some shares around a year ago, which was on the 2nd of October, and he did buy around about 463k worth of shares, which is quite a chunky buy, and he did buy them at £1.28, which actually, when you do look at the stock today, it's actually not too much higher from where he bought a year ago. So yeah, not too bad at all. And the last stock I bought on the list is Card Factory. So once again, this is a stock that I did buy this week. The stock did have a dip after it brought its earnings out, and I thought, you know what, I'm going to start buying some more shares into Card Factory, and that's what I did. It wasn't a big chunk, but it was just a little chunk, and then we'll see where the share price goes from here. 7 times earnings at the moment, which obviously is relatively cheap. You get a 5.4% dividend yield for just holding this stock, which is obviously quite nice. Now, obviously Card Factory, retailer of gifts, cards, on the high street, Done very well because of the cost of living crisis. People went, I don't want to pay for Moonpig, I don't want to pay on the high street for £4 a card at like Morrison's, what have you. You go to Card Factory, you know, £1 cards, £2 cards, a lot cheaper. And also they've done a good job of offering more gifts in the shops. So the average spend at each shop now is starting to go up. They've also announced a lot of good partnerships. So obviously there's not too many more stores that can open up. The key thing they're doing is more partnerships, which has seen them have a lot of success at the moment. And even on the recent update, there was a lot more partnerships announced. There was the likes of partnerships with Aldi and offering the exclusive seller of cards in Aldi, which I think gives them about access to about 1,300 stores. They also have a partnership now to expand into the US, which we don't know too much details on yet on how many stores that is or who it is. That's going to get announced in a few weeks' time, but obviously it's positive because if you're selling more cards, it should lead to more revenue and profitability, and also the reject store that they've already got in Australia and New Zealand at the moment. Now the stock did drop off the recent interim results because they did have a big drop in the profitability, which if you look here, the profit before tax dropped 43%. Now they did warn that this was going to go down because of the increases on minimum wage. However, I think we just weren't expecting it to go down this much. They said by the back end of the year they're going to recover it because it's the Christmas period. That's the big time where people buy cards and volume will help improve the margins. They said that because they're selling gifts, the higher basket amount, the higher spend, the higher profit margin products are going to also help improve the margins and also cost efficiencies and maybe increase prices on the products. They said that they can sort this out by the back end of the year, and that's why they said their full year guidance is unchanged. Now I think the stock did drop because people were surprised by this much and went, there's no way you're going to hit your full year targets, we're going to sell you off. However, that could be the case and that might be proven to be true, and that is now priced into the stock. But if they do what they say and they do get that profit up, they do hit their full year guidance, I think that you'll be thinking, I wish I bought some shares at £1.05. So that's what I'm going to do. And even if I'm a little bit wrong, a lot of that's kind of priced into the stock now, and as well as that I'm also going to pick a 5% dividend yield up while I wait, which isn't that bad at all. And that leads me on to what did I sell. So those are the 5 stocks that I did buy. I did sell 2 stocks. I didn't sell them all, I just trimmed 2 positions. The first one is JD Sports. The stock has ran up a little bit in the last few months. There was a good trading update out, but this one can be very volatile. And I thought, you know what? I'm up a good, I think it was something like nearly 30% on this position. And I thought, I'm just going to take a little bit of profit off the table. We're all here to make money. We're all here to make profit. That's why we do it. So you know what? I'm going to protect myself a little bit. I'm going to take a little bit of a trim. I took about 5% trim on the position. And if it carries on going up, I'm going to be a winner. If it does have a drop, well, I've got some cash on the side from profit that I've taken and I'll put it back into the position. I've been buying this one for a little bit now, so I've got a nice position size on it. So I thought I'll just treat myself to a little bit of profit on JD Sports. The other one was Watches of Switzerland Group. I did take, I think it was like a 5%, maybe it was 10% trim on Watches of Switzerland Group. Same again, it had run up a little bit. That wasn't really actually the reason why I did take some profit. The reason why I did take some profit is because on the last trading update, they basically came out with the shortest trading update that I've seen, and there was no actual financial numbers on there. They did say that they are currently in line with full year guidance still, which is great if they do get there, and I'll be totally wrong on this. But I thought just because there's no actual profit or revenue numbers on the trading update, I didn't know if they were telling the truth or if they were pulling wool over our eyes. So just a little bit of risk management going on there, that I was up a little bit. I thought, let's take a little bit of profit off the table and then we'll see where we're at. Same again, a bit like a JD Sports. If it goes down, hey, I've got more cash to buy. If it carries on going up, I'm going to be a winner because I've still got quite a nice position of Switzerland, Watches Switzerland Group. And same again, you know, we're here to make money. That's what I'm here to do. And I'm going to lock in a little bit of profit, and I can either go buy more stocks or I might go treat myself to something like a Nando's. We'll see what happens anyway. So yeah, that is the UK stocks I'm buying October 2024 edition. Hope you enjoyed the video. Hope you enjoyed me sharing with you what I bought, what I sold. Let me know in the comments comment section what you've been buying and selling as well. Apart from that, I will probably not do a video on Saturday or Sunday unless you get me to 16,000 subscribers. So I'll see you on Monday unless you are on the Patreon. If you are on the Patreon, I'll be doing the exclusive stock request video, and we will be looking at B&M, and I'll drop that on Saturday or Sunday for you guys on the Patreon if you're on there. Like I said, £5 a month, guys, but by the end of the year, that end of 2025, that will be going up to £10. So get in there while you can at the cheaper fee. Hope you enjoyed the video, guys. See you in a bit.